You're about to check out online. Cart total is $237. That little voice in your head says, that's kind of a lot. But then you see it. Four interest-free payments of $59.25. And suddenly, $237 doesn't feel like $237 anymore. It feels like 60 bucks, which is totally manageable, right? So you click the button, you split the payment, you feel smart. And here's the uncomfortable truth. You just got played. Not by a scam, not by some shady operation, but by a business model so psychologically sophisticated that it's literally rewiring how your brain processes the concept of money. My name is Minted Finance, and I spend way too much time thinking about how buy now, pay later services are fundamentally changing consumer behavior in ways that most people don't even realize. If you're someone who's ever used Affirm, Afterpay, Klarna, or any of those services and thought, this is way better than a credit card, hit subscribe and give this video a thumbs up, because we need to talk about what's actually happening to your brain when you split that payment. Here's the thing. Buy now, pay later isn't new. Layaway has existed forever. Credit cards are literally buy now, pay later. But what companies like Afterpay and Klarna figured out is that if you change the psychological framing, if you change how the transaction feels, you can get people to spend way more money than they would otherwise. And the data on this is absolutely wild. According to a study by Credit Karma, 44% of buy now, pay later users have made a purchase they wouldn't have made otherwise, specifically because the payment plan was available. Let me say that again. 44%. Almost half of users are buying things they literally would not have bought if they had to pay the full price up front. That's not a payment method. That's a spending trigger disguised as a convenience. And it gets worse. The average buy now, pay later user spends about 18% more per transaction when using these services compared to traditional payment methods. 18%. You're not getting a deal, you're not being financially savvy, you're spending more money, you just don't feel like you're spending more money. And that difference between reality and feeling is worth billions of dollars to these companies. Now look, I know what you're thinking. But Minted Finance, there's no interest. I'm paying the exact same amount I would have paid anyway, I'm just spreading it out. How is that bad? And that's exactly what they want you to think. Because here's what most people don't realize. The absence of interest doesn't mean the absence of cost. The cost is in your behavior change. The cost is in the psychological rewiring that makes you more likely to spend, more likely to impulse buy, and less likely to feel the pain of payment that normally keeps your spending in check. Let me explain how this works neurologically, because this is genuinely fascinating and kind of terrifying. When you make a purchase, your brain experiences something called the pain of payment. It's a real thing. Neuroscientists can measure it. When you hand over money, the insula, the part of your brain associated with pain and negative emotions, lights up. This pain acts as a natural brake on spending. It makes you hesitate. It makes you question whether you really need something. It's literally your brain protecting you from financial self-harm. But here's where it gets interesting. The intensity of that pain is directly related to how you pay. Studies using fMRI scans show that paying with cash creates the most pain, swiping a credit card creates less pain, and splitting a payment into 4 installments with buy now, pay later, that creates almost no pain at all. Think about it. When you see 4 payments of $25, your brain isn't processing $100. It's processing $25. That's what you're evaluating. That's what you're comparing to your budget, to your bank account, to what feels affordable. And $25 feels like nothing. $25 is dinner. $25 is a couple of drinks. $25 doesn't trigger the pain response that stops you from making bad purchases. MIT did a study where they had people bid on basketball tickets. Some people were told they'd pay in cash, others were told they could pay with credit. The credit card group bid 63% more on average. 63%. Same tickets, same people, just a different payment method that changed how their brains process the transaction. Now imagine that effect supercharged by payments that don't just defer the pain, but fractionate it into amounts so small they barely register as spending at all. This is why retailers love buy now, pay later services so much that they're willing to pay for them. Because yeah, when you use Afterpay or Klarna, the merchant is paying a fee, usually between 2 and 8% of the transaction. They're literally paying money to let you split your payment. Why would they do that? because they know you'll spend more, way more, enough more that the fee is worth it. Shopify released data showing that merchants offering buy now, pay later see an average 50% increase in conversion rates and a 35% increase in average order value. Let me translate that. People are buying more often and spending more per purchase when these options are available. The merchants aren't offering you a favor, they're making a calculated investment in triggering higher spending. And the companies running these services, they're not making their money from you paying interest. They're making it from merchants paying fees and from the percentage of users who miss payments and get hit with late fees. A firm reported that in 2023, merchant fees accounted for about 70% of their revenue. They're not in the lending business, they're in the spending enablement business. Now, you might be thinking, okay, but I'm responsible. I never miss payments. I use these services strategically for things I was going to buy anyway. And maybe that's true. But let me ask you this. Are you sure? Because the data suggests that even people who think they're using these services responsibly are changing their behavior in ways they don't recognize. A survey by LendingTree found that 34% of buy now, pay later users have made a late payment. 72% of users said they've spent more than they could afford. And here's the kicker. 55% of users have used buy now, pay later specifically because they didn't have enough money to make the purchase outright. More than half. These aren't people strategically managing cash flow. These are people using payment plans to buy things they can't afford. And this is where the rewiring really happens. When you use buy now, pay later regularly, you're training your brain to disassociate spending from consequence. You're essentially giving yourself permission to not think about whether you can actually afford something, because the question isn't, can I afford $200 anymore? The question is, can I afford $50 right now? And the answer is almost always yes. Here's what most people don't realize. Your brain doesn't naturally think in installments. It's not wired to track multiple simultaneous payment obligations. When you have 4 different things you're paying off in 4 installments each, your brain doesn't add that up to see the total. Each payment feels small, manageable, separate. But they're not separate. They're cumulative, and they stack. Let me show you how this plays out. Say you use buy now, pay later for a $200 purchase in January. 4 payments of $50. Then in February, you use it for a $150 purchase. Then in March, another $100. By April, you're making payments on 3 different purchases simultaneously. That's $100 in payment obligations every 2 weeks on top of your regular expenses. But because no single payment feels significant, because you never sat down and decided, I'm going to commit $100 every 2 weeks to installment plans, it doesn't feel like a big deal until your account is mysteriously low and you can't figure out where all your money went. The Consumer Financial Protection Bureau found that buy now, pay later users are significantly more likely to overdraft their bank accounts, carry credit card debt, and have delinquent debt compared to people who don't use these services. And this isn't because buy now, pay later users are inherently less financially responsible. It's because the service itself changes behavior in ways that lead to worse financial outcomes. Think about it like this. Imagine you're on a diet, and someone invents a plate that makes food look 30% smaller than it actually is. You'd eat more, right? Not because you're weak-willed and not because you don't care about your diet, but because your brain makes decisions based on perceived size, and the perception has been manipulated. That's exactly what buy now, pay later does with spending. It makes purchases feel smaller than they are, so you make more of them. And the companies know this. They've designed every element of the user experience to maximize this effect. The checkout button that says pay in 4 interest-free installments in big friendly letters, the smooth, frictionless approval process, the fact that you don't even need to enter payment information again once you're set up, the cheerful notifications that say payment successful instead of reminding you how much you still owe. Every single detail is engineered to make spending feel good and consequence-free. Here's where it gets really concerning. These services are increasingly popular with younger users who don't have credit cards. According to research from C+R Research, 37% of Gen Z consumers have used buy now, pay later services. For many of them, it's their first experience with credit-like products. And that's a problem because they're developing their relationship with spending, with debt, with financial decision-making through a system that's specifically designed to minimize financial pain and maximize impulse purchases. When you get your first credit card, there's at least some friction. You have to apply, you might get rejected, there's a credit limit that forces you to think about how much debt you're taking on. The monthly statement comes and you see the total, and if it's scary, that fear can be a learning experience. But with Buy Now, Pay Later, there's no application, no rejection, no visible accumulation of debt. Just a series of small, manageable payments that feel like nothing until suddenly you're juggling 6 different payment plans and your bank account is empty. Now look, I'm not saying Buy Now, Pay Later is evil. I'm not saying it should be banned. I'm saying that if you're going to use it, you need to understand what it's doing to your decision-making process. You need to recognize that this isn't a neutral tool. It's a tool designed to change your behavior in a specific direction, towards spending more. And the evidence is everywhere. Afterpay's own marketing materials to merchants literally say that their service turns browsers into buyers and increases average order value. That's not about convenience, that's about conversion. That's about getting you to buy things you weren't going to buy and spend more than you were going to spend. Here's the math that nobody wants to do. Let's say you use Buy Now, Pay Later and it causes you to spend 18% more per year. If you normally spend $20,000 on discretionary purchases, that's an extra $3,600. Over 10 years, that's $36,000 in additional spending. And sure, there's no interest, but that's still $36,000 you spent that you otherwise wouldn't have. $36,000 that could have been invested, saved, used to pay down actual debt, or just kept in your account as a buffer. And that's assuming you never miss a payment. Afterpay charges a late fee of 25% of the payment amount, up to a $68 cap per order. Klarna charges up to $7 per missed payment. Affirm reports late payments to credit bureaus. The interest-free framing makes people think there's no cost to being late, but there absolutely is. This is where it gets interesting. Traditional credit cards are required to disclose APR, fees, and terms clearly because they're regulated as credit products. But most Buy Now, Pay Later services have avoided being classified as credit, which means they face less regulatory oversight. They don't have to check your credit in most cases. They don't have to verify your income. They don't have to assess whether you can actually afford the payments. They just let you split it and hope you figure it out. The CBFP is starting to look at this more closely, but as of now, these services exist in a regulatory gray area that lets them operate with fewer consumer protections than traditional credit products. And that should concern you, because it means there's less stopping them from implementing policies and practices that prioritize their profits over your financial health. Now you might be thinking, okay, Minted Finance, I get it. These services are psychologically manipulative. But what am I supposed to do? Just never split a payment? And no, that's not what I'm saying. What I'm saying is that if you're going to use Buy Now, Pay Later, you need to implement guardrails that your brain won't naturally create. First, treat every installment purchase as if you're paying the full amount upfront. Before you click that button, look at the total cost and ask yourself, would I buy this if I had to pay all of it right now? If the answer is no, then don't buy it. The installments are a payment structure, not a justification. The total cost is still the total cost. Second, track your installment obligations like they're bills. Don't let them be invisible. Create a spreadsheet or use an app where you list every Buy Now, Pay Later purchase, the total amount, the payment schedule, and when it'll be paid off. Update it every time you make a payment and every time you add a new obligation. You need to see the cumulative impact because your brain won't naturally track it. Third, set a hard limit on how many simultaneous installment plans you'll carry. I'd recommend no more than 2 at a time, maybe 3 if you're really disciplined. Because once you get beyond that, you lose track, the payments blur together, and you stop being able to accurately assess how much of your monthly budget is already committed. Fourth, never use Buy Now, Pay Later for anything under $100. If you can't afford to pay $50 or $75 upfront, that's a sign that you shouldn't be buying it at all. Using installments for small purchases is the biggest red flag that you're using the service to enable spending you can't afford, rather than to manage cash flow strategically. And fifth, and this is crucial, every time you use Buy Now, Pay Later, put the full purchase amount into savings immediately. If you buy something for $200 with 4 payments of $50, transfer the full $200 to a savings account right when you make the purchase. Then use that savings to make the installment payments. This does 2 things. It ensures you actually have the money, and it recreates the pain of payment that the service is designed to eliminate. If you can't afford to do this, you can't afford the purchase. Now here's the thing that nobody wants to admit. Buy now, pay later isn't making your life easier. It's making your spending easier, and easier spending is not the same as better financial management. In fact, for most people, it's the opposite. The whole point of financial management is to make spending harder, to create friction, to force yourself to think before you buy. Every feature that makes spending more frictionless makes your financial life more dangerous. One-click ordering, saved payment information, auto refill subscriptions, and yes, buy now, pay later. These aren't conveniences. These are conversion optimization tools designed to reduce the psychological barriers between I want this and I bought this. And I know this sounds cynical, but it's just true. These companies are not your friends. They're not offering you a service out of generosity. They're offering you a service because they've calculated that you'll spend more money if that service exists. Every dollar you spend beyond what you would have spent without their service is pure profit for someone else. The average American household has about $8,000 in credit card debt. The average buy now, pay later user has about $800 in outstanding installment balances at any given time. And here's what concerns me. Buy now, pay later is growing fastest among people who already carry credit card debt. It's not replacing credit cards, it's stacking on top of them. People are using installment plans to buy things while simultaneously carrying revolving credit card balances, and that's a recipe for financial disaster. Because here's what most people don't realize. Buy now, pay later doesn't fix the underlying behavior that causes debt. It just makes that behavior feel better. If you're someone who struggles with impulse spending, with buying things you can't afford, with keeping your spending under control, giving you a tool that makes spending feel easier and less painful doesn't help you. It hurts you. It's like giving someone who struggles with alcohol a drink that doesn't taste like alcohol. The problem isn't the taste. The problem is the consumption. And look, I get it. I get the appeal. I understand why breaking a $200 purchase into 4 $50 payments feels better. Our brains are wired for immediate gratification and loss aversion, and buy now, pay later exploits both. It gives you the immediate gratification of getting the thing you want while minimizing the immediate loss of seeing your bank account drop by $200. It's psychologically brilliant, which is exactly why it's financially dangerous. The solution isn't to never split a payment. The solution is to recognize what's happening when you do, to understand that the companies offering this service have spent millions of dollars researching how to make you spend more, and they've succeeded. Every time you use buy now, pay later, you're entering an environment that's been optimized against your long-term financial interest. So here's my challenge to you. For the next 3 months, track every single purchase you make with buy now, pay later. Write down what you bought, what it cost, and be honest with yourself about whether you would have bought it if you'd had to pay the full amount up front. At the end of 3 months, add up how much you spent and compare it to what you normally spent. I'm willing to bet you'll see that 18% increase, maybe more. And then make a decision. Maybe you decide the convenience is worth the extra spending. That's fine. At least you're making that choice consciously. But I suspect most people, when they actually see the numbers, when they actually confront how much more they're spending, will realize that this isn't a convenience. It's a costly behavior modification tool that's been marketed as a benefit. Your brain is plastic. It can be rewired. And every time you use buy now, pay later, every time you split that payment and feel that little dopamine hit of this is affordable, you're literally creating neural pathways that associate spending with pleasure and disassociate it from consequence. You're training yourself to ignore the pain of payment, to dismiss the importance of affordability, to prioritize immediate gratification over financial stability. And the companies profiting from this, they're counting on you not to notice. They're counting on you to think it's just 4 payments instead of I'm fundamentally changing my relationship with money. They're counting on you to focus on the convenience and ignore the cost. But you're watching this video, which means you're paying attention, which means you have a choice. You can let these services rewire your brain, or you can rewire them. You can use them consciously, strategically, with guardrails in place, or you can recognize that maybe the best move is to not use them at all. Because at the end of the day, the best financial decision you can